Time for the latest earnings outlook now with Research Director Shiraz Mian. Shiraz, Q3 wasn't really that bad, but it wasn't really that great either. We established that the last time we spoke here. Now we've got about, 90% of the S&P companies that have reported as we sit here and talk on November the 11th. Recap the scorecard for us, would you?
Sure. I have the scorecard that I share with folks in the earnings trends reports reproduced here. As you rightly pointed out, 89.6% of the S&P 500 members have reported results. That's 450 of the 500. 7.2% is earnings growth for these 450 companies, and 71.3% are beating earnings estimates. Revenue growth is 4.2%, and 57.3% are beating revenue estimates. I have this new column that I've started showing in the scorecard, which shows the earnings impact. This is the price impact on the individual stocks to their earnings announcement. So it measures the stock price change from the day before to the day after.
I see.
And it's a handy tool when aggregated to the sector and the S&P 500 level to see how stock prices have responded to the earnings announcement. You will see that that retail is the weakest, followed by basic materials. Pretty much most of the other sectors, as we know already, have been doing pretty good.
We'll get to retail in just a moment. For the quarter,
okay,
percentage growth, 7% range?
That's right. I have this chart which puts the earnings and revenue growth rates in the context of how these results compare to the previous quarter as well as the average for the preceding four. So you could see 7.2% earnings growth on 4.2% revenue growth. And that's below what the same group of companies reported in the preceding quarter, which was the second quarter of 2014.
Mm-hmm.
But it's better than the average for the same group of companies in the 4 quarters prior to that. The 4 quarter, I mean, through the second quarter of 2014. So growth is better than the last 4 quarters, but below what it has been in Q2.
You talked about earnings beats a moment ago. Published reports show that this earnings season is seeing the highest percentage of companies topping earnings per share estimates since the second quarter of 2010. Is that correct?
That's right. That's absolutely correct, as I showed in the scorecard earlier. And then I have this similar comparison for same comparison that I had for growth rates. I have comparison for the beat ratios too. And you could see here that the 71.3% beat ratio for earnings is the highest we have seen in a while. It's definitely higher than Q2. Mm-hmm. It's definitely higher than the average for the preceding 4 quarters. Hard to make an overriding generalized narrative out of this, particularly when you see that unlike the earnings beat ratio, the revenue beat ratio isn't that stellar. 57.3% companies are coming ahead of top-line estimates, which isn't bad, but it's below what we had seen from the same group of companies in Q2. Mm-hmm. The best explanation I could come up with for the very strong earnings beat ratio, which, as you rightly point out, is the best in the last couple of years, that estimates in the run-up to the start of the Q3 earnings season had fallen more than they needed to.
So explain this to me a little bit more. What is that saying about these companies going forward? Because Q4 guidance is trending lower, right?
Absolutely. There's 2 ways of taking this whole picture in the stride. The one is the more skeptical view, where folks would say that this is this long-established game on Wall Street, where companies will go out of their way to anchor expectations at a level that they could then easily come around and beat them. The idea is that it pays to beat estimates than to just come around and meet estimates, and that's been a trend we have been seeing for more than 2 years. There's some truth, in my judgment, to this notion that management teams are out there to manage expectations. But my sense is that if the outlook was really good, then they will be sharing that with us. So the agreeing that there is this notion of managing expectations, which has been a big reason for why these estimates have been coming down, why guidance has been consistently negative. But on top of that, the outlook actually has been difficult as well. And just to confirm the negative guidance aspect that you refer to, this is what we are seeing for Q4. Estimates for earnings growth in the current quarter, which is 2014 Q4, were for growth of 9.6%.
I was going to say it was pretty high.
That's right, and it has come down to 4.3%. And with the bulk of the remaining companies in the retail sector, I would expect that perhaps we will see even more downward pressure on these growth estimates in the coming days.
All right, let's talk about retail now. You've mentioned it twice, so
That's
let's
right.
talk about the focus this week, week of November 10th, 2014, is retail earnings. And you know, since consumer confidence, consumer sentiment right now are at the highest levels that they've been in 7 years, what do you think the retailers are going to benefit from that, or are they going to benefit from that?
You know, it's a very interesting phenomenon that we are witnessing in the market right now. Typically, you would expect consumer spending and the fortunes of the retail sector to move in sync with each other. The outlook for consumer spending definitely is looking up. And you mentioned those confidence measures. I could add more elements. Gasoline prices have been coming down.
Right.
We've had steady improvement on the labor market front. The economy overall is doing good, and that's all showing up in confidence numbers. And that should help improve spending, household consumer spending in the fourth quarter. But that doesn't mean that every retailer will benefit from it as well, to the same extent. And part of the reason for that is this overly promotional environment that we have been seeing in the retail space, and that most of the retailers have been complaining about for some time. And I think that trend will continue in Q4 for the retailers. On the margin, I would expect the retailers, particularly at the lower end of the spectrum, to benefit from some of these factors. The lower gasoline prices have to help buying power for households, and should improve the results for some of the discounters. Though Walmart came around some time back and guided lower, we'll see how they discuss the business outlook and their results today. Not today, this week, I mean.
This week, yeah.
That's right.
All right, we'll see how it shakes out here going into the end of the year. In the meantime, you can read Shiraz's comments on aggregate earnings trends in his earnings trends text piece on Zacks.com, and daily during the peak of earnings season in Ahead of Wall Street, another column that he writes for Zacks.com. You can access both of those right off the homepage. With Shiraz, I'm Terry Ruffalo.